Hello, hi friends. So this is a course where we are going to introduce to the stock markets first, and then we will delve into all the deeper aspects of the stock market. Stock market being one of the biggest financial areas where people invest and activities take place. So there is lots to cover. So let's start with just a brief introduction to the stock markets. And as you know, the stock markets is a centralized place where publicly traded companies shares are bought and sold. It plays a crucial role in the flow of capital, enabling businesses to raise funds and investors to grow their wealth. Now we'll go through how the stock represents ownership of companies and how they are listed on the exchange. So we will define stock as a representation of ownership of a company, a fundamental concept in the stock markets. It is important for investors to understand this concept as it forms the basis of their investment in a company. This slide explains the role of shareholders as an individual or entity holding shares in a company, highlighting their ownership and participation in the company's profits and decision-making process. Now, dividends are payments made by a company to its shareholders from its profits, emphasizing its significance in generating returns for investors and the potential impact on investment decisions. Now, here we explain a portfolio as a collection of investments held by an individual or institution, underscoring the importance of diversification and asset allocation for investors. And a bull market is a period of rising stock prices and optimism, highlighting the positive market sentiment and potential investment opportunities during such periods. Here we explain a bear market as a period of falling stock prices and pessimism, emphasizing the challenges and risk mitigation strategies during such market conditions. Now, market capitalization as the total value of a company's outstanding shares, illustrating its significance in determining the size and valuation of a company. Volatility is the degree of price fluctuations in a stock, highlighting its impact on investment risk and potential returns. Now, earnings per share as is profit divided by the number of outstanding shares, emphasizing its importance as a key financial metric for investors. Here we explain the safety of margin or the margin of safety as the difference between a stock's intrinsic value and its market price, underscoring its relevance in assessing investment risk. This slide explains or defines bid-ask spread as the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, highlighting its role in understanding market liquidity and transaction cost. Here we explain the debt to equity ratio, which measures a company's financial leverage, illustrating its importance in evaluating a company's capital structure and financial health. This slide defines a market index as a benchmark that tracks the performance of a group of stocks, emphasizing its role as a barometer of overall market performance and investment benchmarking. Liquidity is basically how easily an asset can be converted into cash, or when you go to sell your stocks in hand, then is there a buyer or number of buyers who can buy it from you easily at a reasonable price. Diversification is the practice of spreading investments across different assets in order to reduce risk. By diversifying, investors can minimize the impact of any one investment underperforming, as losses in one asset may be offset by gains in another. This strategy is commonly used to create a well-balanced investment portfolio that can weather market fluctuations and provide more stable returns over time. Blue chip stocks refer to shares of well-established financially stable companies, or we can say that financially stable companies that have a history of consistent performance and are generally considered to be reliable and safe investments. These companies are typically industry leaders with a strong track record of profitability, and they often pay regular dividends to their shareholders. Blue chip stocks are known for their stability and seen as a less risky investment option compared to smaller or newer companies. Investors often return to blue chip companies. Investors often turn to blue chip company stocks as a way to preserve capital and generate steady returns over the long term. Now, what is PE ratio? PE ratio, or price to earning ratio, is a financial metric that compares a company's stock price to its earnings per share. It is used by investors to assess the valuation of a company and determine whether the stock is overvalued or undervalued. A high PE ratio may indicate that the stock is overvalued, while a low PE ratio may suggest that the stock is undervalued. The PE ratio is an important tool for investors to analyze and compare different investment opportunities in the stock market. What is future contracts? Now, futures are financial contracts that obligate the buyer to purchase an asset or the seller to sell an asset at a predetermined price on a specified future date. These contracts are commonly used in commodities trading, allowing investors to speculate on the future price movements of items such as oil, gold, agriculture products, etc. Futures can also be based on financial instruments like stocks or bonds, providing a way for investors to hedge against potential price fluctuations. IPO is a very central term used in the stock markets. Initial public offering. IPO is the process by which a privately held company offers its shares to the public for the first time. This allows the company to raise capital from public investors and provides them with an opportunity to own a stake in the company. The IPO process involves underwriting by investment banks, regulatory filings with the Securities and Exchange Commission (SEC), and the setting of an initial offering price. Once the shares are issued to the public, the company becomes publicly traded on a stock exchange, and its shares can be bought and sold by investors. What is a stock split? A stock split is a corporate action that involves dividing existing shares into multiple shares to adjust the stock price. This means that each shareholder will receive more shares, but the total value of their investment remains the same. Stock splits are often carried out to make shares more affordable for individual investors and to increase the liquidity in the market. Now let's go through some more terminologies that are used in the stock markets commonly. So for new investors, the stock market can seem intimidating. Important terms to understand are like stocks, dividends, bull market, bear market, volatility, and familiarity with these concepts aids in making better investment choices. So let's understand something about stock prices. Stock prices are always changing due to supply and demand. Factors such as company performance, investor sentiment, and economic conditions all affect the price investors are willing to pay for a share of stock. It is important for investors to track these prices or price movements in order to make informed decisions. Now, what is a stock exchange is a very important thing to know. A stock exchange is a marketplace where publicly traded companies, stocks and securities are traded. It provides liquidity for buyers and sellers, transparency in transactions, and regulatory oversight for fair and orderly transactions. Now let's define what stocks and shares are. Stocks or shares represent ownership in a publicly traded company. As we have explained earlier, by buying a stock, an investor gains a claim on the company's assets and earnings. This allows individuals to participate in a business's growth and success, with potential benefits including capital appreciation and dividend payments. Now, what are some types of stock orders which we use in the execution of our buying and selling of stocks and shares on the stock exchange? Now, types of stock orders are, for example, market price or a market order, which is comprising of current price. So market order is an instruction to buy or sell a stock at the best available current price. This type of order executes immediately, but the final price may vary from the expected price. Now, limit order is basically it's a specific price we are going to execute the trade at. So a limit order sets a specific price at which the investor is willing to buy or sell a stock. This order only executes if the stock reaches the limit price or better, providing more control over the transaction price. Now, stop order are basically we use to limit our losses. So when we are in long position or a buy position, we fix a stop order. Even when we are in a sell position or short position, we put a stop order. So this is for limiting losses. So a stop order, also known as a stop loss order, is an instruction to buy or sell a stock once it reaches a certain price. This helps limit loss or locks in gains by automatically executing the trade. Now, what is a stop limit order? The stop limit order combines a stop order and a limit order. It executes a trade once a stock reaches the stop price, but only at the specific or specified limit price, or better, providing more flexibility. Now let's go into what is bid and ask prices, which is again very common on all terminals and screens where you are trading stocks. Now, bid and ask prices are terms used in financial markets to describe the price at which a buyer is willing to purchase a security. Bid price. So purchase a security means bid price, and the price at which a seller is willing to sell a security, which is ask price. So sell a security is ask price and purchase a security is at bid price. The bid price is typically lower than the ask price, creating a spread between the two prices. This spread represents the potential profit for market makers and provides liquidity in the market. The bid and ask prices are constantly changing as buyers and sellers enter and exit the markets, reflecting the supply and demand dynamics of the securities being traded. Market capitalization, or we call it market cap in short, is the total value of a company's outstanding shares. It is calculated by multiplying the current stock price by the total number of shares. Market cap is a key metric for investors to assess a company's size and value. It provides a snapshot of a company's financial health and is used to categorize companies as small cap, mid cap, large cap, which are commonly heard of. Now, what is dividend and dividend yield? So a dividend is a distribution of a company's earnings to its shareholders. It is typically paid in cash or a pre-share basis, providing a steady income stream for investors. So let's study a bit about dividend. A dividend is a distribution of a portion of a company's earnings to its shareholders. Dividends are typically paid in cash or a per share basis and can provide a steady stream of income for investors. This we have already studied. Now, dividend yield is the ratio of a company's annual dividend per share to its current stock price, expressed as a percentage. It represents the return an investor can expect from a stock's dividends. So basically, yield is the entire year's dividend, which is divided by the stock price. So it is a kind of percentage yield or a percentage return from that particular stock. So we'll cover this in much more detail when we do all the ratios and the multiples. And calculating the yield. To calculate dividend yield, divide the annual dividend per share by the current stock price and multiply by 100. This metric helps investors evaluate the income potential of a stock investment. Now, these two yields are used for investors to check their returns and compare to their other investments. So we'll cover this in more details. Now, bull and bear markets, as we've already explained, is basically a bull market is a financial market characterized by rising prices and investors' optimism is there. It is typically associated with strong economic growth and high levels of confidence in the market. On the other hand, a bear market is a financial market characterized by falling prices, dipping prices, and investor pessimism. It is because of many wrong negative news in the market. It is typically associated with economic downturns, recessions, low levels of confidence in the market. Both bull and bear markets are natural parts of the market cycle and can present opportunities for investors to buy or sell assets at advantageous prices. Now, what is short selling and short interest? Basically, short selling is a trading strategy where an investor borrows a security and sells it on the open market with the intention of buying it back at a lower price in the future. The difference between the selling price, which would be higher, and the buying price, which would be lower, is a profit for the investor in a short selling strategy. Short interest refers to the total number of short interest or open interest in shorts is used to refer to the total number of shares of a particular stock that have been sold short by investors. It is an important indicator of market sentiment, as high short interest can indicate that investors are bearish on the stock, while low short interest may suggest bullish sentiment. Both short selling and short interest play a significant role in the dynamics of the stock market and can impact the overall performance of individual stocks and markets as a whole. Now, volatility is always there in the stock market, which causes the risk in trading the stock markets. So let's cover a bit in that. Stock market investing hinges on understanding this volatility and risk. Volatility shows price fluctuations, presenting both opportunities and challenges. Risk pertains to potential losses or uncertainties in meeting goals. Properly managing these aspects is vital for sound investment decisions. Assessing risk tolerances, diversifying investments, and staying updated on market trends are key strategies. Now we'll cover more about the fundamental and technical analysis in the next video.